Okay. We're going to buy the sell stops hovering just above our fair value gap, coming off our bullish order block formed during the open of our AM session. Post 9:30. And I want to see that drive us into our buy side liquidity pool at 33,873, which is just below our hourly SIBI and a premium. I'm going to anchor a fib. Take it from the low of the fair value gap up to the buy side liquidity pool. That would be our implied dealing range. We're going to buy these sell stops inside the fair value gap. Buy that. Just set the high there. I think we didn't refine it. There we go. Set the high of the fair value gap. Assuming we leave from this point, can dig deeper and into this lower short-term fair value gap. But assuming this is the low for now, anchor the fib there. That would be our implied dealing range. So our first target would be above this high here. The third quarter of our range. These highs would be our first target. Just below our final target at that buy side. So this is a scalp. Approximately 80 points. But as soon as we trade away from this fair value gap, we'd want to find support at equilibrium of our implied dealing range. Okay. You can anticipate when to see a fair value gap form, where we'd find support, and where we can potentially consolidate. So generally that'd be just above, at or just above equilibrium. Here, below this price leg, we have a bullish order block, mean threshold on the daily. That price left at New York Open. That's what that level is here. Stop loss below mean threshold of this. These two down closed candles. Our final target. Note this bullish order block, these consecutive down closed candles inside of here, which formed a fair value gap. Note this was formed inside of the opening range, okay? Which is 9:30 to 10 a.m. So that's also in my mind as part of the context. So if we wanted to set the high of the day for the New York session, we would have not traded above this high, which did respond off a rejection block. Okay, so if we wanted to see lower prices, we would have remained below this price leg, this price swing during the opening range. Like to see us leave this range, and that would make this entire range balanced. It's placed higher during 9:30. Fair value gap on the 50-minute, traded into that. Left, forming another fair value gap. Fell short of our buy side pool, consolidated, traded back into our inefficiency, and we should see price leave. That would make this range balanced. So if we form one more fair value gap, we could see that left open, ideally, to see the run for buy side. So I'd like to see a breakaway gap form soon. Once I see a more discernible short-term fair value gap, I'm going to move my stop just below that. At this point, we'll move break even just below this down close candle. Equilibrium, implied dealing range. We want to see price show aggressiveness through that. First partial would be above these highs, or the third quarter of our implied dealing range. So this level here. Actually, we could close around 70 to 80% here. That's your choice. Close 70% there. And we'll move our stop below equilibrium once we reach our first target. Mean threshold, bullish order block. Don't want to see price close below that. At this point, I'd want to see price leave. First portion off. Stop below equilibrium, and you can match that with the mean threshold of this bullish order block. Looks like we're going to run for our target now. Close the majority, if not most, not all your position as we hover just below that buy side liquidity pool there. We're going to let it run for the sake of presentation. Remember, you've already captured a portion of the move from this fair value gap to that high, this implied dealing range. Already captured a portion of that, if not almost all. Note where we're seeing hesitation within our implied dealing range. Let's see price leave that.